Most people lose money in the stock market for one simple reason. It's a hard truth, but it's a critical one to understand if you ever want to achieve consistent, long-term success. The reason isn't a lack of intelligence, and it's not because the game is hopelessly rigged against the little guy. Though sometimes it can certainly feel that way. The real reason is much simpler, and far more common. They're guessing. They're treating the stock market like a casino, a place where you throw money at a flashing screen and hope for the best. They're not investing. They're gambling. This guesswork takes many forms. Maybe it's buying a stock because you saw it mentioned a dozen times on a social media forum, propelled by hype and emojis rather than any solid financial data. Or perhaps it's investing in a company simply because you're a fan of their products, without ever looking at their balance sheet or understanding their business model. It could be chasing a stock that's already shot up 200%, driven by a fear of missing out, only to buy in at the absolute peak. Or conversely, it's panic selling a solid company during a market dip because headlines are screaming about a crash. This approach is a recipe for anxiety and ultimately for financial loss. It's an emotional roller coaster, where your decisions are dictated by the two most destructive forces in investing: fear and greed. You feel a rush of excitement when a stock you randomly picked goes up, and a pit in your stomach when it plummets. You're constantly reacting, never acting with a clear strategic purpose. You're a passenger on a wild ride, completely at the mercy of market sentiment and headline noise. You're adrift in an ocean of information without a compass, a map, or even a clear destination. But what if I told you there's a better way? A way to navigate this complex world with confidence and clarity. A way to silence the noise and focus on what truly matters. What if you could stop guessing and start knowing? The world's most successful investors, people like Warren Buffett and Peter Lynch, didn't build their fortunes by throwing darts at a board. They built them by developing a deep fundamental understanding of the businesses they were buying. They weren't buying ticker symbols, they were buying pieces of actual companies. Companies with factories, employees, products, and customers. They understood that behind every stock is a living, breathing business, and the long-term success of the stock is inextricably linked to the long-term success of that business. This is the core principle that separates professional analysis from amateur speculation. It's about shifting your mindset from that of a gambler to that of a business owner. It's about learning to read the story a company tells through its financial statements, to identify its strengths and weaknesses, and to evaluate its position within its industry. It's a skill, and like any skill, it can be learned. It doesn't require a PhD in finance or a secret algorithm. It requires a framework, a process, and the discipline to follow it. Today, I'm going to show you how to analyze a company like a pro. I'm going to give you that framework. We are going to cut through the complexity and build a step-by-step method for evaluating any public company. We'll walk through the exact process that serious investors use to build a complete 360-degree view of a business before they even think about investing a single dollar. We'll cover how to assess a company's financial health by looking at its revenue, profits, and debt. We'll explore how to identify a durable competitive advantage, that special moat that protects it from competitors. We'll even touch on how to evaluate the quality and integrity of its management team. And let me be perfectly clear about what this is not. This is not a get-rich-quick scheme. There will be no hot stock tips, no predictions, no hype. I'm not going to tell you what to buy. I'm going to teach you to think for yourself. The market is saturated with so-called gurus who promise to have all the answers, who predict the next big thing with unwavering certainty. But the truth is, nobody can predict the future. Nobody knows with certainty where the market or any individual stock will go tomorrow, next week, or next year. Trying to predict short-term price movements is a fool's errand. Our goal isn't to predict the rain, it's to build an ark. It's to find wonderful businesses that are built to withstand any storm and thrive in the long run. Our entire approach will be grounded in one thing: just facts. We will focus on verifiable data, on historical performance, and on the tangible realities of the business. We will replace emotion with evidence, speculation with investigation, and anxiety with analysis. By the end of this video, you will have a powerful, repeatable checklist that you can use to analyze any company you're interested in, giving you the confidence to make your own informed investment decisions. You will no longer feel like you're guessing, you'll be an analyst. So, if you're ready to stop gambling and start investing, let's begin. Analysts say one thing, YouTubers say another, and somehow nobody agrees. That's because predictions don't make you money. Understanding businesses does. By the end of this video, you'll know exactly how to break down any company in minutes. When you're learning to analyze a company, it can feel overwhelming. Where do you even begin? With all the numbers, reports, and jargon, it's easy to get lost. But professional investors and analysts have a system, a starting point that cuts through the noise. And the very first thing they almost always look at is revenue. Think of it as the financial heartbeat of a business. Before we dive into profits, debt, or any other complex metric, we need to understand the top line. So, what is revenue? In the simplest terms, revenue is the total amount of money a company brings in from its sales of goods or services. It's the gross income figure from which costs are subtracted to determine profit. If a coffee shop sells 100 cups of coffee at $5 each, its revenue for that period is $500. It's that straightforward. This number represents the pure, unadulterated demand for what the company offers. Now, why is this single number so critical? Because it's the foundation upon which the entire business is built. A company can't be profitable without revenue. It can't grow without revenue. It can't innovate or hire new talent without a steady stream of income. This leads us to a fundamental truth in investing. If revenue isn't growing, the business isn't growing. A company with flat or declining revenue is like a plant that's stopped reaching for the sun. It might survive for a while, but its long-term health is in serious jeopardy. It signals potential problems like losing market share to competitors, a decline in product demand, or ineffective sales strategies. So, how do we measure this crucial growth? The most common method is looking at year-over-year, or YoY growth. This compares the revenue from one period, say the first quarter of this year, to the revenue from the exact same period last year. This method is powerful because it helps smooth out any seasonal fluctuations. For example, a retailer will always have a massive fourth quarter because of holiday shopping. Comparing that quarter to the third quarter would give a misleading picture of explosive growth. But comparing it to the fourth quarter of the previous year gives you a true apples-to-apples sense of whether the business is expanding its holiday sales. Let's look at a simple example. If a company had revenues of $100 million in year one, $120 million in year two, and $150 million in year three, we can see a clear, positive trend. The YY growth from year 1 to year 2 is 20%. From year 2 to year 3, it's 25%. Not only is the revenue growing, but the rate of growth is actually accelerating. That's a company moving in the right direction. This consistent upward trend is what investors get excited about. It shows that the company is successfully capturing more of its market, its products are resonating with customers, and its management team is executing its strategy effectively. Conversely, a lack of growth is a major red flag. If a company's revenue is stagnant year after year, it suggests it has hit a ceiling. It might be in a mature industry with no room to expand, or it might be losing ground to more innovative competitors. For an investor looking for capital appreciation, this is a clear signal to be cautious. As the saying goes, no growth, no investment. Why would you put your capital into a business that's standing still when you could invest in one that's actively expanding? But looking at just 1 or 2 years isn't enough. To get a more stable and long-term view, we use another powerful metric, the compound annual growth rate, or KGR. KGR smooths out the volatility of year-to-year growth rates to give you a single, representative number that tells you the average rate at which revenue has grown over a specific period, typically 3, 5, or 10 years. Think of it this way. YoY growth gives you a snapshot, a picture of what happened last year. CAGR gives you the whole movie, showing you the overarching trend across several years. A company with a consistent double-digit CAGR over 5 years is demonstrating durable, long-term strength. It proves that its growth isn't a one-time fluke but a sustained pattern of success. When you're looking at a company's financial dashboard, you'll want to find both of these numbers. Look at the YoY growth to understand the company's recent momentum. Is it accelerating or slowing down? Then, look at the 5-year CAGR to understand the long-term historical performance. A healthy company will ideally show strong numbers for both. Strong recent growth built upon a foundation of long-term steady expansion is the gold standard. It tells a compelling story of a business that knows how to win in its market and continue winning over time. This is the first, and arguably most important piece of the puzzle. In our last step, we looked at revenue, the total money a company brings in. It's an exciting number, often the headline figure that grabs everyone's attention, but a mountain of revenue can be misleading. It's what we call a vanity metric. It tells you how much money is flowing the business, but it says nothing about how much is actually staying the business. That's why revenue means nothing if the company can't keep it. A business can have record-breaking sales and still be on the fast track to bankruptcy. So, how do we find out if a company is truly successful? Now we look at profit. This is the second crucial step in our analysis. Profit, often called the bottom line, is the real measure of a company's financial health. It's the money left over after every single cost has been paid. Think of it this way. Revenue is the salary you earn, but profit is the money you have left in your bank account after paying your rent, your bills, and buying your groceries. It's the money you can actually save, invest, or spend. For a company, this leftover cash is the engine for future growth, innovation, and returns to shareholders. The journey from revenue to profit is a simple but revealing equation. Revenue minus expenses equals profit. To truly understand a company, we need to dig into that middle part, the expenses. What is the company spending its money on? Expenses can be broken down into two main categories. First, there's the cost of goods sold, or COGS. These are the direct costs tied to creating the product or service. For a car manufacturer, it's the steel, the tires, and the wages of the assembly line workers. For a software company, it might be server costs and data center expenses. A lower COGS relative to revenue is a great sign, indicating the company is efficient at producing what it sells. The second category is operating expenses. These are the costs of running the business that aren't directly tied to producing a specific product. Think of things like office rent, marketing campaigns, research and development, and the salaries of the executive team. These are the costs of keeping the lights on and the business moving forward. By subtracting both COGS and operating expenses from revenue, we arrive at a very important figure: operating profit. This tells us how much money the core business is making before accounting for things like interest payments on debt or taxes. It's a pure measure of the business's operational efficiency. After we account for interest and taxes, we finally arrive at net profit, the ultimate bottom line. This is the final amount of money the company has earned. This is the number that can be reinvested back into the business to fuel growth, or paid out to shareholders as dividends. When you hear that a company is profitable, this is the number they're talking about. Now here's a critical warning sign you must watch for. A company making more money in revenue each year, but simultaneously losing more money on the bottom line, is a red flag. This pattern is often called unprofitable growth. The company might be spending aggressively on marketing or deep discounts to capture market share, hoping to figure out profitability later. While this can be a deliberate strategy, especially for young tech companies in a high-growth phase, it's a risky one. As an investor, you have to ask, is there a clear and believable path to profitability, or are they just burning cash with no end in sight? This brings us to a fundamental principle of smart investing. Growth is good, but profitable growth is better. Profitable growth is sustainable. It means the company isn't just getting bigger, it's getting stronger. It's generating the cash it needs to fund its own expansion without constantly needing to borrow money or sell more shares, which can dilute the value for existing owners. A company that can grow its revenue while also growing its profit margins is a powerful wealth creation machine. So when you analyze a company's profit, don't just look at a single number from a single year. Look for the trend. Is net profit consistently growing over the last 5 years? Are the profit margins, that's profit as a percentage of revenue, expanding, stable, or shrinking? An expanding margin means the company is becoming more efficient as it grows. A shrinking margin, even with rising revenue, could signal intensifying competition or rising costs that are eating away at its success. The direction of these trends tells a story about the company's future. A history of consistent growing profitability is one of the best indicators of a high-quality business that is built to last. Next, debt. Debt isn't bad, but too much debt is dangerous. If a company needs to borrow money just to survive, that's a problem. Here's how we judge debt: interest coverage, trend, and maturity. We want earnings comfortably covering interest, debt shrinking or stable, and no near-term cliff. Strong companies control debt. Weak companies depend on it. A simple gauge. Red means risky leverage. Yellow needs caution. Green signals resilient cash flows and manageable debt. Favor businesses moving steadily into green. Now here's what separates average investors from smart ones. Does this company have an edge? Moats matter. Brands, patents, scale, unique data, or networks that competitors can't easily copy. Loyalty programs and habit loops raise switching costs, lifting lifetime value, and reducing churn. High migration effort, integrations, data lock-in, and training protects pricing power and share. If competitors can easily take customers, the business is weak. The best companies are hard to compete with. You're not just investing in a company. You're investing in the people running it. Do they grow the company consistently? Do they make smart decisions? Bad leadership can destroy a great company. Assess management and governance, candid letters, aligned incentives, smart capital allocation, clean audits, consistent KPIs, independent board, and meaningful insider ownership. Here's your simple checklist. Checklist 1. Revenue growth. YoY and 5-year CAGR trending upward. Checklist 2. Profits rising with stable or expanding margins. Checklist 3. Debt reasonable, strong interest coverage and healthy maturities. Checklist 4. Durable moat, brand, network effects, cost advantages or switching costs. Checklist 5. Quality management, transparent communications, aligned pay, and disciplined capital use. If you can answer these, you're already ahead of most investors. Notice what we didn't do. No predictions, no guessing, no hype, just facts. If you want to learn how to actually build wealth step by step, hit that subscribe button and I'll break it down for you every week.